This audit aims to assess the compliance, accuracy, and efficiency of Avenir Medical Systems Inc. using the IFRS framework as a standard. Our scope and objectives include recommending actionable adjustments suitable for the reporting period of April 15th, 2022. Information used was sourced by financial records, internal control, and management reports. The date of the audit is between the dates December 31st and April 5th, 2022. This audit is performed by P.W.C, People with Calculators. The date of this report, April 1st, 2022. The initial purchase of hardware in 2018 included one main error related to asset cost measurement. The $8,000 early payment discount should have been deducted from the asset's initial cost as required by IAS 16. A significant expenditure to upgrade hardware in January 2020 was incorrectly expensed. The upgrading improves efficiency and provides future economic benefits, qualifying it as enhancement and requiring it to be capitalized under IAS 16. The disposal and replacement for an old printer in a non-monetary exchange was also incorrectly accounted for. IAS 16 requires the transaction to be treated as a non-monetary exchange with commercial substance, necessitating two key steps. Measurement of the new asset, the cost of the new printer should have been measured at fair value, plus any cash paid, the recognition of a gain or loss on disposal. A loss must be recognized, calculated as the fair value of the old printer less its carrying amount.
Now I will highlight the company's revenue recognition issues. The company records all subscription and support and professional service revenue upfront. This breaches IFRS 15, which requires separate performance obligations and recognition over time. As a result, year one revenues are overstated, while later years are understated. Renewal fees are also booked immediately at license expiry before contracts are signed, which is premature under IFRS. The correct treatment is to spread subscription revenue evenly over 3 years. Allocate professional service 70% in year 1 and 30% in year 2, and defer renewal fees over 12 months. Retroactive adjustments are required.
Avenir capitalized costs for a 15-month period and delayed the start of depreciation for 3 months after the buildings were ready for occupancy. This treatment is inconsistent with IFRS standards. The treatment violates IAS 23, which mandates that capitalization must cease when the asset is ready for use. It also violates IAS 16, which requires depreciation to begin when the asset is available for use, irrespective of management's personal decision for delaying the physical move-in. These errors led to an overstatement of the building's carrying amount and an understatement of expenses for the first quarter of 2021. The action taken must involve a retrospective adjustment to reverse all capitalized costs from January 1st to March 31st, 2021, and immediately recognize them as period expenses.
There are several issues. First is change in useful life and depreciation method from IAS 16.61, IAS 8.36-37, revelation to 200,000 from IAS 16.31-42, no impairment dispatch, physical damage from IAS 36.9-12, management override from IAS 1.15-17. Here are several recommendations. Conduct a full independent audit and restatement of Avenir's financial statements, reassess PPE values using professional appraisers, implement proper governance and internal control systems.
Since acquiring their server farm in 2018, the company violated 2 key accounting rules. They incorrectly expensed $100,000 of setup and installation cost instead of capitalizing them, which is against IAS 16 rule. This mistake further understates the depreciation every year. Secondly, they failed to perform impairment test despite internal reports indicating poor performance and no projected cash flow past 2021, which violates IAS 36 rule. After fixing the initial mistake, the asset's fair value is $2.46 million, but the recoverable amount is only $1.88 million. This triggers an impairment loss of about $580,000. The company has overstated both its property, plant and equipment and its net income.
Firstly, the audit findings. We noted that the investment classification used, such as trade or available for sale, didn't match any of the permitted IFRS categories. The company also failed to properly recognize fair value changes, interest accruals, or required disclosures. As a result, several carrying amounts were misstated. For example, Tesla shares should have been reported at fair value. They decreased from $360 at the end of 2020 to $330 at the end of 2021. IBM shares also increased from $140 to $156, but the related unrealized gain wasn't recorded. And for national bank bonds, the 2% annual interest wasn't accrued, nor were fair value adjustments made. Now, for the IFRS 9 valuations, under IFRS 9, investment must be classified based on the business model and the SPI test. Equity investment should be measured at fair value through profit or loss, and bonds either at amortized cost or fair value through OCI. The company didn't follow these rules. Specifically, they didn't measure investments as fair value at period end or recognize the related gains, losses, and interest. As a result, we identified a misstatement of accounts. Assets, income, and equity are all overstated. Let's talk about government grants. The company recognized the entire grant immediately, which goes against IAS 20. Grant income should be recognized gradually or deferred. They also didn't set up a liability of reverse income when conditions were met. Because of this, the $500,000 recognized in 2018 overstated both income and equity. Additionally, if half of the grant, $250,000, became repayable after 2020, that portion should have been reversed and recorded as a liability. Now, let's talk about the violations of IFRS IAS 20. Under IAS 20, grant income must be recognized only as related costs are incurred, such as depreciation of funded assets, or deferred as a liability until all conditions are met. If conditions fail, the grant or part of it becomes repayable, which wasn't reflected here. Now, the misstatement of accounts means income was overstated and liabilities were understated.
For the accounts receivable findings, we first found out about the allowance for the accounts, doubtful accounts. Earlier, they used to account 3% of allowance on the uncollectible accounts, but in 2021, they stopped recording any allowances, which led to the IFRS 9 violation, the recognition of expected credit losses. Secondly, the thing was the factoring of the receivables. At October 2020, Avenir factored $1 million of receivables with recourse and received 95% of it and removed the receivables from its books, which was wrong, because the company may recognize a financial asset only if it has transferred substantially all the risks of ownership. But the thing was, it was with recourse, so they still had the risk of default. These all things led to the misstatement of the accounts by overstating the assets because the receivables was wrongly removed, understatement of the liabilities because the obligation to the factor was not recorded, and this led to the misleading net income. Thank you so much.
This audit has discovered materially relevant concerns, specifically regarding the overvaluation of assets and the misstatement of expenses, non-compliant categorization of investments, and unrecognized impairment. In order for the company to publish its financial reports to the public, Avenir Inc. must see that its policies and practices are adjusted to be in accordance with the current IFRS standards. Thank you, the P.W.C. team. People with calculators.